Hey everyone, welcome back to the Week in Charts. Charlie Bilello here, your host, and as always, I'm going to run through the most important charts and themes that we're seeing today. A lot to discuss, but I want to start out with that inflation report that we got this week. And really, I think the bigger question beyond that report is simply how long will inflation remain elevated? So now we seem to be in a range of between 3 and 4%. And we know the Fed wants to get that rate of inflation back down to 2%. So what we're seeing here is a picture of the US inflation rate since June 2022. And what happened in June 2022? Well, the CPI peaked at 9.1%. That was the highest rate we've seen since the early 1980s. And after that, what we saw is really a steady decline, lower 12 consecutive months of declining rates of inflation, came all the way down to 3% in June 2023. But since then, we've seen a little bit of a move higher here, three straight increases now up to 3.7%. And that 3.7% number was a little bit higher than expectations, which was for 3.6%. So if we look at that overall inflation picture, what we're seeing is if we include food and energy, prices have been moving higher in terms of the inflation rate. But if we exclude them, look at that core rate, it continued to move lower. So 4.1% lowest core rate of inflation in the US since September 2021. Still, of course, very high, but I think that would be the encouraging part of the report if you're looking for something positive here. And the expectation is that probably should continue to go lower because we should see shelter housing inflation move lower, and that being by far the biggest component there. And we'll talk about that in a little bit. So, in terms of the inflation rate being at 3.7%, why is it lower than the 9% we saw in June 2022? Well, simply because everything, with the exception of shelter and transportation, are seeing lower rates of inflation today, and many of them significantly lower. If we look at something like gasoline, increased 3% over the last year. Back in June 2022, we were looking at a 60% increase for gasoline. And that goes for many of these categories, a substantially lower rate of inflation today. But why is it ticking up over the past few months? Well, I think the biggest factor is simply gasoline and fuel oil moving up over the last few months, and year over year. That's a big change from where we stood in June. So energy prices were very high in June 2022, and then comparatively this June, they were significantly lower, and that helped to push CPI down to 3%. And now we're just simply seeing more realistic comparisons with September of last year. And so that huge tailwind for CPI is now no longer a tailwind and starting to become a little bit of a headwind. But of course, that's dependent on where prices go. In the first few weeks of October here, we've actually seen energy prices start to come down again. So perhaps this will swing in the opposite direction for the next month. But let's talk about that shelter component, biggest component by far, simply because people spend more money on housing than anything else. It's over a third of CPI. And what we're seeing here, the good news is it seems to have peaked. That shelter inflation rate 6 months ago peaked at 8.2%, and now we're down to 7.2%. So six straight declines, but still obviously very elevated there. And if you're looking at this chart, you're probably wondering why it's such a big difference versus what we're seeing in terms of rents. So if you look at listed rents with data from Apartment List, we're actually seeing prices decline slightly over the past year, 1.2% decline. And what's the reason for this disparity? Well, it's simply that the way shelter CPI is calculated, there's just a huge lag in terms of the data. It's not reflecting real-time data whatsoever, and it takes many, many months, if not years now, to reflect this declining rate of inflation in actual housing. So if we look at that sector, what it's been doing is while the actual rents in the US have flatlined here over the past year plus, what we're seeing is shelter CPI is catching up. It really understated the rate of inflation in housing in 2021 and early 2022. And now with a lag, it's playing catch up. So we could see this continue in terms of shelter CPI still showing increases, but I would expect this year over year rate of change to eventually here, I would have expected it to start already show a more significant drop. And when it does, that should help push down not only the overall rate of inflation, but that core rate as well, because shelter is such a big component there. So what's the expectation for CPI for next month? We're not obviously fully through October, but so far the Cleveland Fed is saying we're going to see a tick back down to 3.4%, but again, still in that range, still in the range where the Fed is likely to say that they want to stay higher for longer, because it's still well above their target rate of 2%. So, in terms of that, are we going to see another Fed hike in November when the Fed meets again? That seems unlikely, and the biggest reason for that is the bond market seems to be doing the Fed's job. We talked about last week those huge increases in long-term bond yields, 30-year yield actually hitting 5%. And the Fed seems to be noticing that. We have a lot of comments this week about this, and Dallas Fed President Lori Logan said there's going to be less of a need to raise the Fed funds rate because of these higher interest rates, particularly in the long end. And that's a big shift for her, because she'd been advocating for higher rates for most of the year. And so that projection that the Fed had, if we look at the September meeting of hiking rates one more time this year, perhaps they're starting to walk back from that. And she's not the only one. We saw other Fed presidents and voting members saying, look, these higher interest rates in the long end are going to lead to tighter financial conditions, and therefore the Fed may not need to hike rates again. Again, all of this is subject to change, but the November meeting seems to be more of a pause, as I'll show you in a little bit. But in terms of these tightening conditions, we see it really across the board. First, in the housing market, we now have 30-year mortgage rate continue to move up 7.57%. That's the highest we've seen since December 2000. We know what that has done to the housing market. Extremely tight conditions there, very little activity. And of course, that's going to have an economic impact. If we look at the car market, we just got new data on new car loans. These are 48-month loans, 8.3%. And that's the highest we've seen in 2 decades. So we're talking about just a number of things starting to get more and more pressure. And why is this important? Well, because most people finance the cost of a house. So that's become unaffordable. So demand drops there. Most people finance the cost of a car. Over 80% of people finance the cost of a new car. That's becoming increasingly unaffordable. Less demand there as well. And just the rate of change is important as well. So it's not just that interest rates are high, it's that they're moving high at such a rapid pace. So the increase in that car loan rate from just a year ago, it's 2.78% higher. That's the biggest spike we've seen since the early 1980s. We know back then that eventually led to a recession. And the question, of course, is this going to lead to a recession this time as well, as we see this collapse in demand? And finally, in terms of tightening credit conditions, if we look at credit card interest rates now, they continue to move higher, 21%, highest rate ever recorded. We have data going back to the 1990s on this, and significantly higher than where they were if we look back in March 2022 when the Fed started hiking interest rates. 14.5%. So significant increases for consumers that have credit card balances. And the big question we had been asking is this going to start to lead to a pullback in terms of taking on additional credit? And the answer for a little bit last year was no. And we were wondering, well, when is it going to happen? But it seems to finally be happening today. We got new data on consumer credit, and the rate of increase, 4% year over year, a significant decline from what we were seeing back in 2022, where we saw these huge increases on a year-over-year basis. And if we look at August here, it actually declined. The total level of consumer credit actually went down, which is a pretty rare thing, and it was the largest monthly decline that we've seen since May 2020. So seems to be the consumer starting to be more reluctant in terms of issuing new credit. Interest rates have to be a big part of that, I would think. And so the market is really doing the Fed's job for it, saying that interest rates going up are already leading to tightening financial conditions, harder environment for consumers, and the kind of the demand destruction that I think the Fed wanted to begin with, because that's going to help to lead to lower inflation rates. So if we look at the expectations here from the market, this is looking at Fed fund futures, and the probability of the Fed pausing in November. They meet again November 1st, is now above 90%. So we've seen that move higher over the past few weeks. Obviously, those comments from the Fed being a factor, and this inflation report, I think, with the core rate moving lower, there's really no urgency for the Fed to hike again at this point. And so that if we get to that right before the meeting, we're likely to see the Fed remain on hold. And really, the market is expecting the Fed to hold not just for that November meeting, but to hold for the subsequent meetings as well. The market's saying Fed isn't going to hike again, and that we're actually the next move is going to be a cut, and that cut is going to come in June 2024. And what the market's saying essentially is, even though the Fed is going to start cutting rates in the middle of next year, they're going to do so very slowly. And the terminal rate here, if we look at two years from now, is still going to be elevated. So again, this is going to change wildly if there's a recession, there's if there's a more of a financial crisis or a decline that we see. This is going to shift, and the Fed's rhetoric is going to shift. But for now, market's expectation is that the Fed's on hold, and that by the middle of next year they'll be comfortable cutting rates. And that could either be because inflation has come back down to 2%, or it could be that the economic data is starting to weaken enough where the Fed starts to change its tune and start to be focused more on stimulating the economy than slowing it down. So let's shift gears here, talk about consumer spending. We just mentioned that seems to be consumers pulling back a little bit, but one area of the market that it doesn't seem to be pulling back seems to be the baby boomers, who are spending more than they have ever before. And as a share of total consumer spending, it's about 22% if we're looking at 65-year-olds and older. That's by far the biggest category. Now, obviously, the share of the population that is 65 and older is higher today as well. But even if you adjust for that, I think it's around 17% of the population. They're still spending well in excess of that. And if we look in the past year, well, many age groups have really cut back in terms of their spending. The 60 plus group here hasn't cut back very much. They're spending close to 8% more than they did a year ago. The article in the Wall Street Journal was talking about just a number of different factors, but I think the biggest one is that they had held back on spending for so long, have this extra money, and they want to finally enjoy it and start spending it. And many of them are in much better financial shape than younger generations because they bought homes when they were significantly less in value. They have obviously lower interest rates locked in. They're benefiting now from having higher cash balances. They're earning more interest on those balances. So they seem to be a much better financial position than younger generations. And if we look at the share of household wealth that's held by 70-year-olds and up, it's at a record high 26%. So interesting trend here. Baby boomers, people had always talk about the younger generations being more important for spending in terms of marketing budget, but it seems like the baby boomers and older generations very different here. Obviously, they're living longer, and they're thinking about spending in a different way than prior generations. So let's talk about the banks here, which are still under pressure. We had that huge rally from March through the early end of July, early August, but that rally didn't really bring the banks up with it. Certainly not the regional banks. But if we look at the spread between the Nasdaq Bank Index and the S&P 500, it's just a huge divergence this year. 37% underperformance year to date, which is on pace to be the largest on record, with data going back to 1993 for this index. So enormously wide spread. And I guess the question for market participants is, how is it going to converge? Is it going to converge with banks moving up and closing that gap in a positive way, or is it going to converge with the S&P moving lower? And of course, either one of those can happen, and there's a lot of things that are going to be driving that. But I think the big fear for the banks remains their balance sheet, and the fact, obviously, that interest rates are rising and they continue to rise. Well, that led to problems, of course, with Silicon Valley Bank, and certainly it's obviously must be putting pressure on other banks as well. In addition to that, they have these delinquencies going up in terms of auto loans, delinquencies going up in terms of credit card loans. So far, pretty slowly, but the fear is that is going to accelerate. And you also have that commercial real estate, particularly office overhang, where a lot of the loans that were issued are sitting on the balance sheets of these banks. And I've talked about a number of times on the weekend charts about San Francisco in terms of real estate market there, but it's not just there that we're seeing pressure in the office market. There was an interesting article talking about Texas, which the economy is doing very well. We're seeing a lot of good employment trends there. But if we look at office vacancy rates there, we're seeing a significant rise there as well, around 25% vacancy for Dallas, Houston, and Austin, which is actually above the national average. And if we look at the reasons why, number one, of course, being that secular change in terms of work from home, that hybrid work model, but also we saw that era of low interest rates led to a building boom in Texas. And what we saw in terms of new construction of offices, and this is looking at Austin here, is a significant increase for a long period of time. So you have just this excess supply and then just a huge drop in demand from that change in terms of people working from home more. And that's leading to obviously higher vacancy rates. And so, again, this is just another data point to suggest that we're still in the early stages of what's likely to be a multi-year adjustment for that commercial real estate sector and office sector in particular. And we just saw this week continued spreads moving higher in terms of CMBS securities. So even though equity markets have bounced a little bit from last week, we're not seeing that in terms of CMBS. We're seeing continued stress there. So all of these prices will have to be reset. And that's just a process that takes time. As we said last week, the loans that are coming due aren't coming due all at once, but as they come due, that's where you're going to see the defaults. So, in terms of things coming due, the bill is starting to come due for the US government. And the reason for that is that the national debt continues to explode higher, looking at a $2 trillion increase over the last 4 months. And when you increase the national debt by that much, you have to obviously sell more treasury securities. And there's just been fewer buyers of these securities looking overseas, and the buyers within the US, because it's such a huge amount of supply, there's obviously some pushback, and that's driving the interest rate higher. But in terms of net issuance this year, 1.76 trillion year to date through September. It's on pace to be above 2 trillion by year end, which would be the largest by far of any year, with the exception of 2020 when we did just that massive borrowing and stimulus. So huge move higher in terms of debt. And this is the key point here. When that old debt is maturing, and a good amount is maturing in this year alone, 30% of that debt, well, it's being sold at a much higher interest rate. So when you renew that debt, you're not looking at the same interest rates that you had before. You're looking at substantially higher interest rates. So by 2025, half of this debt is going to have rolled off and at much higher interest rates. And unfortunately, back in 2020, when we did this massive issuance of new debt, we didn't think long term. Most of that was short term issuance. We didn't at the time, even though we had record low interest rates for 30-year debt. We actually had 30-year treasury below 1%. What we should have done is issue that looking out long term, issuing 30-year bonds, 20-year bonds, maybe even looking at a 50-year bond at the time. But they did not do that. They essentially said nothing has changed, and they borrowed very short term. And now that bill is coming due. And this is the impact of that. And this is going to continue month after month, is what we're going to see is higher interest expense on the debt. So you have more debt and you have higher interest rates. And so the expense that you're having to pay is higher and higher for the government. We're up to close to 900 billion over the last year, which is a record high. And this should, at some point in the next few months, likely cross above 1 trillion, and is going to be, if nothing changes, is going to be the largest line item in terms of the federal budget. It's going to crowd out other spending, and it's going to be an issue at some point. The question is, are we going to do something before it becomes a crisis or wait till it becomes a crisis? And thus far, it seems like we're going to wait until it becomes more of a crisis before we attack this. And if we look at the trend over the last 5 years, I think this paints, just step back and paints a broader picture of what we did in a 5 year period of time, which is kind of unprecedented in terms of the money supply and in terms of the increase in national debt. We're talking about 54% increase in national debt, 47% increase in the money supply. So it should come as no surprise that we had the highest inflation rate that we've seen in the US since the early 1980s because of these, directly because of these policies. And if we want that inflation rate ultimately to get back down to a more normal level, we're going to have to change the policy. And the good news is in terms of money supply, while we're not reversing what we did in 2020 by any means, we've slowed down here significantly. So the money supply is actually down over the last year. But in terms of national debt, we're not coming close to making a change here. We're accelerating at a time when the economy is still in expansion. So running a $2 trillion deficit, it would be very high in any period of time, but doing it when you have very strong very strong employment, a low unemployment rate, when the economy is still in an expansion, is very dangerous, because when that recession comes, well, then you're going to have a real demand for the fiscal stimulus. And what is the deficit and national debt going to do during that period of time? So if you want to bring down that inflation rate, ultimately we have to attack these two areas. That's where inflation comes from. There's a lot of talk about all different things, drivers of inflation, but these are the two biggest factors by far. So in terms of the worst case scenario of inflation, there was a lot of talk about hyperinflation in 2022, but thankfully the U.S. is nowhere near that situation. We don't want to get anywhere close to that. So I think it's important for people in the U.S. to study places like Argentina that are having just an inflationary crisis, and it's accelerating here. So if we look at the Argentinian inflation rate, we have CPI at 138%. That's their reported rate of inflation. It could very well be multiples higher than that. Who knows? But their central bank this week raised interest rates by 15% to 133%. And the crazy thing is it's still below their rate of inflation. So as much as they're trying to supposedly attack this, they can't seem to bring it down. That's really from a generation of failed policies, from everything from printing money to deficit spending, and just a number of socialist policies that simply have compounded and compounded to the point where the currency now is basically being devalued by such a large extent each and every month that people's behavior is really changed. So the minute they get paid, this is an interview with someone living in Argentina, and they're saying that the minute they get paid in Argentina, it's really a race. They have to just get that money out of pesos one way or another. Either they spend it immediately or they try to convert it to dollars. And so many of them are converting it to dollars and then not putting it in the bank. What they're doing is putting it in essentially under their mattress or in a safe deposit box. And there's a lot of skepticism there about banks, and that's not a good situation as well. But the question is now, how do you reverse this? How do you get to the point where they're starting to move in the other direction again? And the answer is it's going to take a long time, but you have to change the policies. You can't keep doing what you were doing before. And Argentina has a long history of this. They have defaulted 9 times throughout their history in terms of their national debt, and they're in a situation now where we could see a change. So there's an election coming up. The current president Fernandez is not running for re-election, and we'll see. There could be a change here. The leading candidate, it seems like, on the polls, is actually someone with a very different perspective. He's more libertarian, Milei, and he has a number of radical ideas which seem radical, but perhaps maybe necessary to change things. He wants to end the central bank. He wants to convert to dollars in terms of that being the currency of the country, wants to reduce the government significantly. I don't think any of these will be easy to get done there, but it's interesting to see that people seem to be embracing something different. We'll see if he ends up getting elected. But hopefully something will change for the Argentinian people. And it's really a lesson for the US that uh, things can change in a hurry. 100 years ago, the Argentinian economy was among the strongest in the world. And now you just have decades and generations of failed policies over and over again. And the temptation is always, instead of doing a structural change and saying something's wrong, you do more. So in 2020, they decided to devalue the currency, print more money. Obviously, nobody wants to cut back. Nobody wants to have less in terms in the short run. But sometimes you have to take short-term pain for long-term gain, and that's never popular in terms of getting elected. So it's interesting to hear Milei in the lead here when he's saying some of that. So we'll see what happens there. Hopeful that something will change for Argentina, and I'm hopeful that people in the U.S. are observing this so we don't follow a similar path. There's still time for the U.S. to kind of hold the line in terms of increasing the money supply and increasing our national debt at this crazy rate that we've been doing. So I want to end, as I always do, with something positive, and that's the U.S. is back on the path to prosperity in terms of wages outpacing prices. And it was a very difficult few years for this relationship because wages went up 15% over the last 3 years, and really essentials, if we look at food at home, up 20%, rents up 23%, car prices up significantly. We're looking at home prices up 40%, things like gasoline up over 70%. So very difficult when prices are outpacing wages. And the good news is the most essential of essentials, if we look at food, price inflation there is moving down dramatically. So now we have 2.4% rate of inflation there, down from 13.5%, which was crazy high last year. And this is most helpful, of course, if you go down the income spectrum, you go down to the lowest levels of income. They spend the highest percentage every month on food. And so this is very, very helpful there. I would like to see it go even lower. It would be great if it went negative in terms of this inflation, where we took back some of those increases, but great to see that it's down at this level. Hopefully that continues. And just finally here, this is the chart I always talk about because it's the most important chart for an economy. If you have wages outpacing prices over long periods of time, that leads to tremendous prosperity. That's been the story of the US over the last 100 years. Hopefully it would be over the next 100 years. And we had that long period of negative real wage growth where people are feeling very badly because prices were running up way more than their incomes. And now we have 5 straight months of the positive territory. And I expect October will be another positive month as well. So hopefully this trend continues a while longer. So let's end it right there. Thanks everyone for joining me. Have a great weekend. If you like the content, as always, subscribe to the channel, and I'll see you next time on the Week in Charts. Thanks.